doing this event is recent weeks and months have really been pushing not only crypto, but DeFi and more recently NFTs into the mainstream. Jamie will be discussing his paper, which looks at the transition period between Web 2 and Web 3. And it will relate to user identity, wealth, data, as well as a creative application through digital art and collectibles. So we'll listen to Jamie speak for a while, and then I think what we'll do is we'll open up for some questions from the audience, and we can have a discussion afterwards as well. And like Dagan said, London Blockchain Labs is really key for education and kind of continuing discussion about all things related to blockchain and crypto. So the conversation and the discussion won't stop here. And if it wants to be continued, we can carry on Discord, where we have a few channels related to certain topics. So thank you very much. I think we can get going. Over to you, Jamie.
Sure. So it's always dangerous to invite me to talk without a script or slides. I know you're probably hoping I'd bring slides, but haven't had time. So you might get a bit of a ramble, but hopefully within the ramble, there might be some interesting talking points that we can expand upon as a group. I guess by way of introduction first, so I'm CEO and founder of Outlier Ventures. Outlier Ventures has been around for over 7 years, almost 8. Focused on blockchain and of course have quite an evolving thesis, but we were Europe's first VC dedicated to blockchain, what we call blockchain. Of course, now we've evolved how we talk about that, expanded it into Web3, and then more recently the open Metaverse. And I'll talk about that thesis, the journey of that thesis, and then maybe deep dive a little bit specifically on the open Metaverse. But effectively, when we began Outlier Ventures way back when, there wasn't really a crypto or a blockchain industry as such. There weren't even really startups to invest in. And so as a consequence, I actually brought on a CTO as a co-founder to help me navigate this space, because it was obviously increasingly clear that it would be very technical. And you'll all be very happy to know that you are probably down to the last person more technically qualified than me to talk about any of this stuff. So I find it quite ironic that I'm here lecturing to you guys as to these kind of technologies and innovations, but there you go. So as I said, when we first started out, there weren't really many things to invest in. So we created a studio where we were going to get applied learning, largely by breaking stuff, to allow us to understand how to time these technologies and this stack. Because the most important thing as an investor is timing. You can be right, but you can be too early, and that is very costly. So actually understanding, I think everybody conceptually started to understand what was going to be possible with DLT and all this kind of stuff. But practically, when would you actually be able to leverage this technology stack and apply it to particular applications, market sectors, use cases? And so by playing around with that technology very early, breaking it, understanding the limitations of Ethereum even back then, it allowed us to understand the horizon of Web3 and hopefully be better investors. As the space matured, we became convinced that there was still a huge amount of work and investment that would have to go into the infrastructure layers before any of these use cases at the application layer would be possible. And so we kind of focused primarily on being an incubator. So we worked much lower down in the stack on infrastructure, both layer 1 up to layer 2. And that gave us, by virtue of doing multi-year engagements with projects like Ocean Protocol, Fetch.ai, what was Enigma, which is now Secret Network, a fairly nuanced understanding of the infrastructure layers and like what primitives were missing and to what extent it could scale. And then probably just under 2 years ago, we felt that the infrastructure generally was maturing, not just kind of where we've made investments, and that we might actually begin to focus on the application layer. So we condensed a lot of our learning into an accelerator format, where we now do 3-month accelerator cohorts. We do 3 a year. Actually, that's 4 year now. We've extended it, focused on 2 areas like middleware layer, so making a lot of this infrastructure usable for the 99% of developers that are not currently remotely interested in or building on Web3. And then also the application layer, and of course, the 2 areas which are getting increased attention is DeFi and NFTs, and we'll talk about how that's now begin to form the thesis of the open metaverse. So we're now at the stage where we've got a portfolio of about 35 startups. We will accelerate at least 50 more this year, so we're going to more than double our whole portfolio just in 1 year, which is both reflective of the market that we're in. We're in a bull cycle, but also the maturity of projects that we're seeing entering the space, and the infrastructure that's now available to allow for these use cases to be possible, without adding too much friction, whereby it would kind of limit or constrain user adoption as a startup level. So all in all, there's some really strong fundamentals as to the market now. And I know there was some kind of chat off air about, are we in another bubble, and is it like 2017? So in some ways it is, but in many ways it's not. You'll see me regularly whenever there's a major dip or a temporal dip in the markets at the moment, kind of calming people's nerves that what the markets that we're working in now have much stronger fundamentals, both with regards to Bitcoin, but also like more generally, and greater diversity increasingly of protocols. So yeah, and potentially we might even accelerate up to 100 startups this year. God knows how we're going to do that, but we're talking to a couple of major like top 10 protocols about running their ecosystem accelerators as well. So that would then, allow us to go from a portfolio of 35 to 135 in just 12 months. So we're hiring, our portfolio are hiring aggressively. Many of you would be great candidates, and so that's why I'm kind of investing time in coming to talk to you all. There's such a great pool of talent. So that's kind of Outlier generally. In terms of the thesis and how the thesis has evolved, probably, what year are we now? 2021. So 2017, I think, we increasingly became convinced that the way to think about DLT was to not look at it in isolation, but to look at it as part of a emerging data economy, and one that was more open, one that was more user-centric, and therefore had to be looked at in combination with things like IoT in terms of the production of data. DLT was really how you then coordinated, commodified, and distributed that data. And then, of course, it would be, machine learning would be increasingly the thing that would be consuming that data. And so looking at that data supply chain, value chain, and making sure that it was a better fit with the world that we want to see, rather than highly extractive, surveillance capitalism. So that informed a lot of our investments into things like Fetch.ai, which is looking at machine learning and autonomous economic agents. It informed things like Enigma, now Secret, which was looking at multi-party computation and how you can have privacy preserving or enhancing technologies at the DLT layer. Or of course, Ocean, which is like data marketplaces. And now they've got data tokens, and you're looking at data unions, like how DAOs can collectively own data sets and monetize them and set permission and stuff. So that's kind of been our legacy. And I would say since 18 months ago, we've been a lot more focused on DeFi, and then in the last 8 to 9 months, NFTs. And we believe those things then come together to allow for an open metaverse. So maybe to kind of explain how that thesis has evolved. So I'm assuming DeFi probably doesn't need too much of an explanation, but really caught everybody's attention last summer with the whole food protocols, where there was this kind of rapid forking and iteration of DeFi protocols that were allowing for primitives within the context of borrowing and lending. And of course, that whole cycle was kicked off primarily by stablecoins, being the kind of cornerstone that enabled DeFi to explode. And so I think what was interesting to us about that was clearly it was incomplete, but what it did show was that there was this proto-capital market that was emerging, where in some ways we were rebuilding a Wall Street native to the internet. But at the same time, we're enabling entirely new things like innovations in automated market makers, in flash loans, and some things that just couldn't happen in the existing financial system. And so the way that I kind of understood DeFi was that it was competition and innovation max. So if you think about the existing financial system, it doesn't really innovate because it doesn't have to. The barrier to innovation to be regulated to play, and the capital thresholds and licenses that you require to even validate an idea are prohibitively high to innovation. And so both in an institutional and a retail context, you end up with large incumbents that don't need to innovate. And so, especially in a retail context, this is why you've got low yield on savings, sometimes negative. This is why banking sucks. And so, you know, if you compare that to DeFi with all its imperfections, DeFi is optimized to remove inefficiencies, brutally so, and to optimize for yield. And so actually you end up with incredibly lean, incredibly innovative innovation. Now, of course, that doesn't account for a lot of things that are unsustainable about DeFi. So there are a number of reasons why DeFi is still relatively small, even in the context of crypto, let alone broader capital markets. I think it's still like 1% of crypto. And that's primarily because it's got a UX problem. There's a lot of risk in there. You've got a lot of risk in the composability of the DeFi stack. So its benefit is also its weakness. And, you know, so you've got like slippage and like various things that if you're using combinations of the DeFi stack, just bring risk that is unmanageable to the average person. So, and then you've got like counterparty risk that hasn't been resolved for institutional investors. So, so there's a couple of things that we started to think about. Well, what would DeFi 2.0 look like? What it did demonstrate was you had this innovation competition max, which could clearly outcompete the existing financial system, just because the existing financial system won't innovate. So DeFi, and by the time regulators catch up, which will be at least with a 5-year delay, the market's moved on, much like crypto more broadly, and some of the key protocols will have been matured enough and decentralized enough that they'll be accepted. So basically, there are a couple of things that we felt needed to happen for the mainstreaming of DeFi. So the first one was that you needed to find ways to manage risk. And actually, like most new industries, Forms of cooperative insurance are one ways that you do that. There's a reason why you've got lots of mutuals for like farmers. That still now some of the main Credit Agricole or whatever it is in France was derived from farmers having to insure each other against problems with crop because nobody else could do it. And so you've got the shipping industry had to find ways to insure itself because nobody could insure it. And so crypto is with Nexus Mutual and other things creating the mutualization of risk in the system. And I think rather than requiring the existing insurance industry to do it, there'll just be decentralized forms of insurance, largely borrowing from cooperative or mutualization of risk. So that's just going to happen. But that immediately allows for, because you can't remove risk from DeFi. It inherently has risk as a consequence of its composability and the fact that it just moves so quickly. At the same time, what you can do is help protect against it. Second thing was around, well, how do you bring in, there's the usability part, which to be honest with you, I don't want to dismiss, but it will be solved for. We've got several projects in our portfolio that are trying to aim for like a Robin Hood experience of DeFi, which effectively is abstracting away the complexity of DeFi for a retail investor, but still offering the yield. Or not kind of like food protocol grade yield, but nevertheless substantial yield compared to pretty much anything else that could be on offer to a retail investor. Whether they do or they don't understand slightly underlying mechanics of how that works, it's primarily a UX problem. And actually, I believe if you look at what's happening in a lot of fintech, most fintech startups are losing inordinate amounts of money to acquire market share. And it's no surprise that Jack Dorsey, like the number one way that he's managed to finance his fintech app is through Bitcoin. And so, I think you're going to see a lot more fintech startups that have all the regulatory requirements to onboard retail into DeFi. They have the licenses, they have the ability to build products. They're going to increasingly integrate DeFi, mature DeFi products that have hardened into their products and apps and will act as an onboarding channel. So that's kind of bringing on demand. It's solving the UX problem. It's managing risk. But the other thing I mentioned, like if you really want to prime time DeFi, was you need to bring in institutional money. And the single biggest problem for institutional money is counterparty risk. If you are a regulated financial entity, you have to know that you are trading with a party that has been KYC'd and AML'd. So know your customer and anti-money laundering. I mean, it's ironic that most of the existing financial system is heavily involved in money laundering for drug cartels and dictators from around the world. But nevertheless, of course, crypto is the thing that everybody's really worried about rather than Deutsche Bank. But put that aside, or HSBC, right? Put that aside, the reality is that if you are a DeFi protocol, you do not want to directly be doing KYC and AML because in doing so, you become a counterparty and therefore you need to be regulated. So in the absence of being able to do that, institutions cannot use DeFi protocols, even if they're going through an intermediary. Now, again, there are ways that are being solved for. There's several innovations coming to the market around decentralized identifiers, DIDs, and verifiable claims. DIDs are if you were going to reduce it down to an identity standard from the World Web Foundation that have been going on for several years now, which allows for decentralized identifiers. You can have multiple decentralized identifiers, and they allow for things like verifiable claims. So they allow me to attest to something. So, for example, allow me to attest for something without revealing the underlying data, and therefore having to burden the person I'm proving it to with then securing that data. So, for example, I want to prove to you I'm over 18, but I don't want to have to give you my date of birth or a picture of my passport. And so DIDs and verifiable claims and credentials allow you to do that. So as long as somebody has verified you, and they're a trusted party, and it can be time sensitive and stuff, you then get a proof, and you can use that proof in the system. And so, for example, I could only use a protocol, a DeFi protocol, if I have a proof that somebody else has verified and KYC'd me. And so people are looking at, can you make DIDs and verifiable claims, NFTs, non-fungible tokens, so they can actually even be used multiple times. And so, again, innovations are coming through which fundamentally solve that. A DeFi protocol can stay a DeFi protocol whilst still offering assurances to regulators and institutional money that the counterparty risk has been removed or at least mitigated to a significant level. So, like all of those things, and I've gone a little bit deep in the weeds there, but like the main point that I'm saying is there is enough of an economic incentive to solve all of these problems, and there is enough technology out there that's already pretty mature that allows for these things in combination to be solved for. And DeFi is going to see a huge amount of money sucked into it because it can just offer better returns, and it can do so in a highly efficient way, and it can offer increasingly greater levels of complex financial product. And retail channels and then more institutional players will bring in demand. And that will just eat the world. It will eat the financial markets. But one of the missing things that was highlighted from the DeFi protocols was that this unsustainable yield. So effectively, people were just debasing their own underlying economy by offering ridiculous yield. Now, if you were to think of yield in the context of subsidized marketing, like you do not run a subsidized marketing campaign forever, unless you're in Silicon Valley and VCs give you a load of money to acquire market share, like Uber or some of these kind of winner takes all markets. But unless you've got incredibly deep pockets or access to cheap capital, you can't keep offering 50%, 100% yield like month on month if it's not tied to any underlying income. And so what you ended up was with very promiscuous behavior where liquidity, billions in liquidity, was just hopping from one fork of one protocol to another. And there wasn't really much kind of stickiness. And so the first signs of how that could be solved for were in things like Aave. So Aave, I think it was through a hackathon actually, came up with something called Aave Gotcha, which was a game on top of the protocol where you earn NFTs as collectibles, as gaming items for positive behavior. And so they'd give you some yield, but they could lower the yield, and then they could give you something that they could, in theory, create an infinite amount of, obviously scarce in each edition, but without debasing your underlying economy. And so you could think about it as yield for acquisition of liquidity, and then NFTs for retention and a form of like CRM. And so if you think about that in a complete sense, DeFi and NFTs begin to reinforce one another, where NFTs close the loyalty loop in DeFi. And I think that's going to create very powerful network effects for the next wave of DeFi 2.0. But then, so that's kind of like how we were looking at DeFi and DeFi 2.0. Linked to that, probably 9 months ago or so, I got much more engaged again with NFTs. It had been a long time since I last looked at them. Probably CryptoKitties was kind of the last time I looked at it seriously. It broke Ethereum. Everybody kind of just got distracted and went on and did the next thing. When I looked at NFTs again, summer of last year, I was blown away by the level of maturity of the stack, the different asset types, the level of creatives that were moving into the space through platforms like Super Rare, Nifty Gateway, many of which had no clue about crypto. So they did not arrive at NFTs and NFT platforms because they knew crypto. They just understood it was a new way to effectively sell a digital print. And so for me, this was like a bit of an aha moment, because all of a sudden there was this gateway drug for mainstream people, creators in the digital economy that were learning about crypto because of NFTs. They create a bit of art, all of a sudden they get a load of ETH. They're like, what the hell's ETH? Like, what do I do with it? Well, okay, you need a MetaMask wallet. What's that? They learn about self-custody. And, you're seeing that now, of course, however many months later, we are in like an NFT boom driving a market where you've got collectibles, you've got NFT Top Shots, you've got Blau just did like 4 million in sales of audio NFTs. NFTs for the first time represent an asset in crypto that is understandable to the average person. And so actually I've now, for the first time, I can like talk to people in my friends network who now understand what I do for a living. Like previously when I'm talking about protocols and, utility tokens and, they should go to Binance and buy a token. They're just like, I'm never going to do that, right? Even just like the concept of money isn't something they spend much intellectual time on. But the minute you say, well, it's a digital collectible, so it's digital and it's unique, it's scarce, they get it. Like people immediately get it. And so the interesting thing is that as you've seen this boom happening in NFTs, this is new forms of digital wealth. So if you think about what NFTs fix, digitalness, like the internet, broke most forms of creative value, right? So the minute anything became digital, whether it was a movie file, music file, it became, you could copy it innumerable times and you could share it innumerable times. And therefore it became immediately devalued. So digitalness was great for, say, music, because we can listen to it on any device. You can stream it to millions of people at next to zero cost. But it has turned music into something that is just something you consume. Like you don't collect music anymore. It takes a single out of context of an album. Most musicians now have to make money through touring. They can't do that right now, so they're pretty fucked. All of a sudden, you can have something that is digital, but that holds value and is unique and is an asset. So the easiest way to think of NFTs are they allow the creator to be the platform. It's creator as platform. I can mint a digital asset. I can say how many of there are going to be, so set its scarcity. I can bake in royalties, perpetual royalties, and it can live off the platform I mint it on in perpetuity in the metaverse. And increasingly, these things are becoming more social. So for a long time, they were like just 2D objects. I mean, like CryptoPunks are pixelated 2D objects. They're pretty basic. You keep them in your MetaMask wallet. It's not a very social thing. Increasingly, these things are becoming 3D objects that you can upload into Decentraland. They're becoming digital fashion that you can wear on your avatar or use as a Snapchat filter when you're doing a Zoom call. They're becoming audio, music, audio, visual files. So they're becoming more social currencies, social assets that are experienced in the metaverse. They're becoming in-game items, skins. And so you can think of these as forms of digital wealth. And if you extend it to gaming, like most gaming platforms at the moment where we're spending increasing amounts of time and money, like the wealth is limited to and locked into that platform. You can barely sell it for fiat. There are no real secondary markets for it outside of that platform, let alone even if you could sell it for fiat, selling it for crypto. So I think NFTs are going to unlock all the digital wealth that's currently trapped in the closed metaverse, like gaming environments. It's going to enable entirely new forms of digital wealth. And this then becomes collateral. And most interestingly, and this is where the interplay with DeFi is, I think a lot of people are going to find DeFi through NFTs. So for example, there are villages in the Philippines at the moment that are making a living from play to earn on Axie Infinities, like just churning. This is their main income. It is better than any other form of local income, and this is how they pay their rent. Now, how do they pay their rent with Axes? You can't, right? They've got to get it ETH or USDT. They've somehow got to get that through an off ramp. And the problem with Axes are you can't, if you sell your Axes, it limits your ability to play well, right? You want to collect Axes, you want to have good Axes to be able to play better. So you don't really want to sell them, you want to borrow against them. So what are you going to do? You're going to go into DeFi and use that as a form of collateral, take out a short-term loan, pay your rent, keep playing, earn some cash, pay the loan back. And so I think you're going to see this. So on the one hand, NFTs are a loyalty mechanism for DeFi. They complete the DeFi loop. They're almost like a reward scheme. And then on the other hand, NFTs are a form of collateral that will drive adoption of DeFi and crypto and self-custody and all the things that we care about. So actually, you're going to see this interplay between DeFi and NFTs that compound one another. And this is why I've been saying since last summer that this is going to create a mega cycle. I think we're just in the beginning of it. It'll be at least 12 months. I think it could be a bit more. That will be 3 times bigger than the 2017 ICO boom. And actually, based on more solid foundation. So I did an interview with nonfungibles.com, who have been tracking NFTs on Ethereum since 2018. They've got larger data than anybody else. And I asked them, at what point do they think NFTs as an asset class will decouple from Bitcoin? I.e., just because the price of Bitcoin or ETH goes up, does it mean like the price of the NFTs go down or up? And they said it's already decoupled in this quarter. So NFTs have already decoupled as an asset class from crypto. And they said they actually think that NFTs are now driving price in crypto. So if you think about the previous hype cycle that drove crypto in 2017, it's primarily ERC20 and then platforms like Binance onboarding retail. I think the thing that's going to be driving adoption in this space are the two NFT standards, and then NFT platforms like Nifty Gateway and Super Rare, and they're going to be they're already platforms for music and everything else that will be onboarding millions to billions of people into NFTs without them initially even understanding. And then increasingly, they're going to understand self-custody, they're going to understand all the things that we care about in Web3, and then eventually they're going to get to DeFi. So that is what we now call the open metaverse thesis. It's like, how does the metaverse, virtual worlds, begin to leverage Web3 and Web3 standards and technologies in this stack to become more open? And maybe I just close off on, it's really interesting, Tim Sweeney of Epic Games is already talking about the open metaverse. He's already engaging with several others who are talking about how Web3 can make the open metaverse happen. And of course, he's in charge of, one of the 2 biggest, the duopoly of gaming engines in the world at the moment. So it's like a matter of time before he presses go on NFTs. At the same time, I was on a call yesterday about several major luxury brands moving into NFTs. I was on another call with Snoop Dogg's manager talking about NFTs. Mark Cuban, the CEO of Salesforce, thinking about them in a CRM context. Like, all of a sudden, everybody gets crypto. So it's like really exciting time to be entering the space. But maybe I'll stop wanging on now and let people ask some questions.
Thank you so much, Jamie. That was really, really interesting. You've covered a huge number of things there, and I'd really like to get everyone to ask the questions that they have, particularly as lots of people have differing interests. But let me just quickly get the ball rolling by really just zooming out a bit and thinking about DeFi as an industry and looking at, the kind of the blockchains that run on it and everything. And I was just wondering what your views are on the current Ethereum blockchain, whether it's going to improve in the near future, whether it will take more time to improve in the longer term, and if any competitors like the Binance Smart Chain or any others are going to take a bit of that market share in the meantime.
Yeah, I mean, it's a good question. I think there's a very good argument. Joe Lubin's argument is Ethereum will be the global settlement layer for DeFi. I think right now that feels like a fairly solid statement. The question is, to what extent does everything else happen on top of that? Or is it just an anchor? So, I mean, even if it was just the global settlement layer, that's pretty big. And of course, wrapped Bitcoin is already, being traded with, if not the same, greater level of volume than Bitcoin in some instances, and certainly leverage in DeFi. So I think that's a pretty solid grounding. Ethereum still has the network effect of community. The reality is, in Polkadot or even in other environments like Cosmos, they're kind of just replicating what's happening on Ethereum, and I think they will end up with their own center of gravity. Obviously, there's different configurations that are going to be possible, but equally, they're all building bridges back to Ethereum because they know if they don't do that. And I think this is also true around NFTs, right? So there's Flow by Dapper Labs at the moment looking to build out a specific protocol for NFTs, which is definitely needed. But the reality is, as I said, NFTs need DeFi. And so there's a good argument to say that it's going to take a lot to pull away people from Ethereum. I'm seeing more people leave Ethereum because of NFTs than I am DeFi. And people are using things like Matic as a workaround. And there are things like Biconomy in our portfolio that allow for gasless transactions to happen. But I still think it's got a bit of a center of gravity. I think it's seeing things like Solana making a lot of traction in DeFi as well. But comparatively, it's still tiny. But I think they've all got a good chance. I mean, the reality is I don't think any protocol anytime soon is going to try to totally replace Ethereum. I think what they'll do is they'll begin to take chunks out of it. What happens with ETH2, who knows? Depends who you speak to. If you speak to Gavin Woods of Polkadot, he will say Polkadot is, they were already talking about Polkadot and ETH2 when he was at Ethereum, and it was clear to him it would just never happen within the governance process and construct that is Ethereum. He just felt it was too fragile to make quick decisions and to adapt. But he would say that he's building an alternative, right? So honestly, I don't know. I think that's that's the billion-dollar question. What I would say is that I think it's more likely that Ethereum is going to lose out to NFTs than it is DeFi right now.
Okay, great. And just one more before I pass on to the rest. You seem to be touching on a lot of things about education in DeFi, education in NFTs. I've personally worked with one of your portfolio companies, Keytango, and that's really demonstrated to me the level of education and kind of showing people the ropes of how to navigate themselves around complex DeFi systems. So with NFTs, it's slightly different. You said that, for example, people get it quicker than they get other things in crypto. But do you think that's enough to bring the mainstream into NFTs? I saw Christie's had done an auction with Beeple very recently. Do you think that's going to be the start of something huge, or do you think a bit more time teaching people will be necessary?
I mean, honestly, I like the growth. If you just look at Google search trends for NFTs at the moment, it's exponential growth since the beginning part of this year. like in any NFT project that you speak to, they're all experiencing pretty much near exponential growth. And I think things like Christie's are just validation from a market that's probably going to be disrupted by it all pretty quickly. So it's nice. It's like Bitcoiners have always been anti banks, but they love it when a bank buys Bitcoin, right? And I think it's true. I think that's true with NFTs. But like Beeple, I know Beeple well personally. And the thing about Beeple is, like, before, I think there was like, you can look at NFTs in a post-Beeple context, right? Which is why I think he will be the Banksy of the NFT space, because Beeple was a ready-made, he was a complete market in and of himself. He had a back catalogue of like 13 years of everydays. So when he did his drop for like whatever it was, 4 million over a weekend, that was just 0.1% of his back catalogue, which would value his whole catalogue at about $500 million. And he basically, his single drop over a weekend was greater than the combined sales through Super Rare for the whole of 2020 and 2019. Because he already had millions of users, millions of fans. He had a massive back catalogue of work. I mean, he did not need a platform. He only used Nifty Gateway because he just didn't have time to set it all up in the payment gateways. But when you have a Shopify for NFTs, and that's the big buzzword at the moment, everyone's running after that. We've got a play in our portfolio. But when an artist can self-serve, the creator with NFTs is the platform. Like, I think that the role of a platform, and they will exist, is for curation. And that's important for mainstream. They want things to be curated. They want fiat on and off ramp. But for like people like Beeple or any other major artists that are coming online now, if you look at Blau's drop, he did it through Known Origin. I think it's Known Origin. Yeah, Known Origin. Like, these guys don't need platforms. I mean, anything, they're helping platforms out by bringing them users. So NFTs are like, I can guarantee this, there'll be the first platinum single out this year that's sold entirely through NFTs. I think that's like 1 million sales. That will happen this year. I know that Deadmau5 is trying to do it through one of our portfolio companies. You've got things like artists are looking to sell their entire back catalogs to their fan base through DAOs rather than sell it to private equity firms that then just make yield from selling it to streaming companies. So creators get this because for the first time they have direct control to their audience, not just in the individual NFT, but I did a bit of a tweet storm on this over the weekend. So the interesting thing about NFTs are that they're an atomic unit of socialness within a community. So this is why CryptoPunks are at a premium, aside from being scarce, because you've got new people coming in like Mark Cuban who haven't been into NFTs for a long time, and they want to buy a stake in the provenance of the meme of NFTs. And CryptoPunks are like a unit of mimetic account in the story of NFTs. So having a particular NFT in your wallet demonstrates status. And at the moment that's like very introspective into crypto and crypto memes. But if you think about it as, so let's say Blau's drop. So let's say you bought a Blau audio NFT. By the way, it's an album I think he released 3 years ago. That's the crazy thing about it. It's not even a new album. But so why would you do that? Like, you could have bought the album 3 years ago. Well, it's not necessarily because people want to build it because they're not going to be able to listen to it any other way. It's because they now have a way through which Blau can communicate with them. So, for example, people are doing things where if you have an NFT, a specific NFT in your wallet, you can get access to a Discord server or a channel in a Discord server. We're actually testing it we created some OV NFTs where you can actually book in time in my calendar using it. So they become social currencies. Eventually, Blau's going to be doing concerts in the Metaverse. So this will be like a ticket, a perpetual VIP ticket. you've already bought it, but he knows you're one of his kind of key fans because you bought one of his limited edition drops 2 years ago or now. And so you've got status both in the community and then with him personally as a creator, where he can continually reward with access or even new drops. If you've got one token, you get exclusive access to 5% of every drop here on in. So they become like an access token. They become a social asset. They become status within a meme. So like creators immediately get this. You don't need a record label. You don't need a publishing company. You don't even need, like Kendrick Lamar doesn't need to go on Fortnite anymore and play in somebody else's virtual space. Like he could just do his own thing in Decentraland, bring his ready-made audience, and then monetize it directly himself. So I think like most marketplaces, you start with supply and demand comes. You've got an almost oversupply of content creators coming into NFTs, and with them, people like Kendrick Lamar or artists, they've already got millions of users. So they are going to be the ones that bring in users into crypto. And if you combine the aggregate user base of all of these creators, it like dwarfs Binance's user base. It dwarfs Coinbase's user base, which is why I'm so bullish on it. We're talking like billions of users.
Yeah, that's really interesting, the application to the music industry and what value that can produce. So I've got a hand up from Maria. If you wouldn't mind unmuting yourself, and if you'd like to show yourself on the video as well.
Hi, I have a couple questions. The first one is, you mentioned luxury brands are moving into NFTs, and I'm just curious if you could share like the way in which that they're looking to do that. And then my second one is, so obviously NFTs are really good for people who already have a huge following, like in the music industry, you mentioned Kendrick Lamar. However, is it also just as good for small artists, like small digital artists? What are the benefits for them? Or is it you have a following and then you have huge benefits from that?
Sure, thanks, Maria. So the first one about luxury brands is, so you've probably seen like Balenciaga recently actually built their own virtual world, which is never a good idea for any brand to do, but apparently it was all right. But a lot of luxury brands are getting into digital wearables. So there's a trend called direct to avatar, which is like a play on direct to consumer. We've got a portfolio company called Crucible.network you should check out. And they're working with a number of brands to create digital wearables for your avatar, in anything from VR chat through to Decentraland through to like more closed gaming platforms. And the reason why fashion brands like that is, of course, it's cool. It extends their reach into the metaverse. But actually, if you think about it, it makes sense, right? So if you're a luxury brand, you don't want to be fast fashion, right? You actually want to say, like if you're Rolex, right? The whole argument of Rolex is it's an investment. You're buying this thing, it's timeless, it's going to last forever. And it's going to be something you'll pass down to your future generations, right? That's like the promise of any luxury item. So one, it confers status. And so, of course, like if you want status in the real world, you want status in the metaverse because we're spending increasing amounts of time there. And you want to customize how you look. But the second thing is you want a luxury digital asset to be timeless too, and to be seen as an investment, which of course an NFT is. An NFT is something that you can resell much more easily than a bit of clothing that you put on that maybe you have a fag burn in or whatever else, right? So for them, it actually reinforces the idea of this timeless brand that maintains a premium. Second question about creators and like, does it serve a long tail of creator rather than like the fat tail, like the big artist? Yeah, absolutely. So another way of thinking about it is obviously crowdfunding for creators has been a thing for a while, primarily on like Kickstarter or whatever. People get a stipend from their fans to create an album or whatever else. But these things are limited to platforms, and the problem is they're often like for intangibles. So you'd give a money to a band, and like maybe you get an album back, or like, and if you're really lucky, maybe they invite you to like the first concert. But you can't really do anything with that. Like so the great thing about NFTs is they offer fluidity, right? So things called like bonding curves. Some of you are probably familiar with those, but like if I find a new artist and I think I'm a great tastemaker and I want to help them out, then I might speculate on their future. But that doesn't mean I want to like wait 5 years for them to become famous, right? Maybe I want to cash out after a year. So I want to help them in their first year, but actually as they start to like evidence themselves, then I can exit very easily on that bonding curve. So it allows for, and a lot of creators, if they're purist about this, might hate this, but it's the financialization of the creative process, where you can have markets, secondary markets around an artist. Now you can still just do donations. Like some artists, like they don't really want to extract money. They don't want to be commercial. They don't want to be popular even. But a lot of them do. And I'll give you an example. And of course, like you could argue some of the things might be overpriced now, but I know multiple artists, not necessarily musicians, but young artists who are in like the middle of nowhere. So like they're in Prague, not exactly in the middle of nowhere, but like not in London, not in New York. Like they don't have a network. They didn't go to the best, university. They didn't go to St. Martin's College. Like how do they become globally famous and recognized from their living room? It's like very hard. A lot of them are making like a lot of money right now from their home studio. There is no barriers to them reaching all the benefits of global distribution, but without the requirement that they're debasing the creative asset that they're making by it becoming digital. So I think this probably better serves the long tail than it does the fat tail. So yeah, absolutely. One final point, that's why the Shopify of NFTs is important, because increasingly Nifty Gateway is only going to be working with Beeples because they just want big sales from artists that already have millions of people demanding that asset. They're not going to break a new artist. It's just like the net economics that don't work for them. So that's why you need an independent artist to be able to leverage the same tooling themselves, create a storefront, have smart factory, smart contracts that can allow them to mint an NFT, bake in royalty rights without the need for a platform. Platforms will still curate, but they're going to bias towards like blue chip artists, be it musicians or anything else. That's why you need a Shopify. And the great thing is in this space, of course, NFTs are all based on open standards. So no one platform has a monopoly on this technology.
Thank you.
Okay,
that was
brilliant.
really helpful.
So I'm just conscious of the time. So there's a lot of questions to get through. So let's try and run through them fairly quickly. So this is from the chat, I believe from Charles. The question is about identity. So do you need adoption of a universal identity standard to make the Metaverse OS operate, or can sets of overlapping webs of trust suffice?
Yeah, great question. Ultimately, it's the elephant in the room with Web3 generally. And I'm like constantly shouting about this, that you can't have a decentralized web until you have decentralized identity. Nobody yet has effectively deployed DIDs and verifiable claims yet. They will. Like we invested in Sovereign and it had Evanim, and they had a load of bullshit in the US with US regulators, which limited their ability to bring it to market. There's a new startup being stood up outside of the US, which will be bringing this to market, primarily in an enterprise context. But then you've got Crucible.network, who have taken the Sovereign standard and then are reapplying it in a gaming context, but with a tokenized component. So yes, you absolutely need DIDs and verifiable claims to have an open metaverse. That said, at the moment, we are still, Web3 functions primarily through MetaMask. Your kind of MetaMask and your wallet is your identity, which is not great. And it's fairly diffusive. You're losing lots of different kind of wallets and stuff like that. So yeah, it's critical. Somebody needs to make it happen. We're investing quite heavily in a number of different opportunities in that space.
Brilliant. Over to you, Ray. There you go.
Hi. Thank you very much. Just a question on NFTs. I'm seeing an increasing level of functionality attached to these NFTs, and I see the value of them when they're digital native, such as clothes to your avatar. But just as an NFT on its own, such as the art piece on Nifty Gateway, do you think that this is a trend that's going to continue?
Yeah, so I think NFTs are going to be increasingly multimedia. So like 2D pixelated art, I think is more indicative of what I was saying about the meme of NFTs generally. So, like, why is a CryptoPunk or, even a Trevor Jones, right? These are, they don't necessarily have mainstream appeal, right? They're very kind of self-referential to crypto. I collect things like John Norlander, who's a visual communications professional, works in the advertising agency, doesn't need to do NFTs, but he's creating a lot of like Bitcoin, crypto references in his artwork because it sells. Now, the reason why these things hold value, and to be honest with you, I didn't participate enough in things like CryptoPunks. So I was like, pixelated 2D art like that's not going to be worth anything. Like the minute that mainstream come along and there's new supply coming into the market and a Banksy's tokenized, like nobody's going to care about pixelated CryptoPunks. But I was wrong, because actually, if you want to show you're an OG of NFTs, like being able to show that you have a CryptoPunk is the way that you do it. That's why Mark Cuban is like or like Gary Vee is all over CryptoPunks at the moment, because they are buying status. And if you show you've got one of these things in your wallet. So again, like I tweeted over the weekend, I think it's Marshall McLuhan, the medium is the message. You need to look at NFTs in the context of the medium is the message. So don't pay attention to the content of an NFT. It's almost irrelevant how it looks, even what it can do right now. It's what it represents. And so what NFTs represent currently are status and social utility in the context of the meme that is NFTs.
A great answer, actually. I've never really thought of it that way, so nice. I think we have a question from Gibran.
Hi, Jamie. So my name's Gibran. I'm a member of the LBL Labs team. I'm currently actually developing an NFT protocol, kind of looking at functioning NFTs. So basically, during development, I found that the Ethereum gas fees are a real kind of issue with what I've been developing, and it's made me look at other blockchains, and Flow is one that's stood out because of NBA Top Shot and what they're doing there. But sort of when I looked more into NBA Top Shot, I found that it's actually quite centralized, even though it claims to be like an NFT platform. Do you think that is potentially dangerous? Because obviously NBA Top Shot is extremely successful. So do you think sort of mainstream will start using that as a model and potentially moving away from what NFTs are meant to be, which is a decentralized asset, as opposed to a centralized asset where the keys are controlled by the platform?
Yeah, I mean, so we're already seeing this. So a lot of platforms, NFT platforms, where people are minting work, because they've had workarounds with Ethereum, they're doing a lot of things off-chain. A lot of the metadata is off-chain, including royalties, and the the more established artists are starting to realize that now. Like, I think OpenSea have just done a fix, but previously, you sell it on Nifty Gateway, it then goes on to OpenSea. There's a resale for like $200,000 and the artist doesn't get anything, or they're reliant upon somebody to do it manually. So I think as you end up with more blue chip assets emerging in NFTs, there'll be increasing focus on things like royalties, increasing focus on on-chain metadata. And so that's why we invested in something called NFT42. NFT42 are the guys behind Avastars, and they are like almost zealots about on-chain royalties.
Have you heard about Zora, the Zora protocol?
I haven't, no.
So actually, Zora is what I'm working with quite a lot, and basically what I've been using as a base for my protocol. And it basically has, it allows you to like assign bid shares to an NFT, so that when you sell it on, you can assign creator, you can assign basic creator percentages for any sell on.
Right.
And so yeah, it's really cool. So I've been using that for the base of what the NFT protocol I'm developing at the moment. And yeah, I think it solves that problem. I found that, and it not only that, it provides sort of a good finance, like stream of finance for the actual platform as well, because whoever's minting it. So I think it's a good sort of middle ground, I guess, between platforms being profitable and creators making money. So yeah.
Yeah, well, I mean, ping me a link on Twitter or LinkedIn or whatever to the project you're working on, and also Zora. I'd be interested to see that. I mean, I think, look, the reality is that something like Dapper Labs, I mean, I know Roham really well. They've just gone out at they raised a 2 billion valuation. They've got huge brand franchises wanting to roll things out with them. And to be honest with you, their brand licensing departments right now don't care about it. It's like, what do you mean we can sell this whole new revenue stream for things like called NFTs? Like, they've got no clue. They don't care. You're just giving them a new revenue stream. Now, as you say, what will start to happen is increasingly as more money comes into the space, they'll start to understand there'll be an added premium on assets that have more on-chain metadata. So at the moment, that premium doesn't exist because the market doesn't understand. And we're still in this hype cycle, but you'll start to have this divergence between assets that have all the associated metadata and those that don't. And so, I think that discrepancy we're not seeing in the market yet. But that is why we invested in NFT42. So you should definitely check them out. And they're building a lot of factory smart contracts that you can just self deploy.
Yeah, that's cool. Yeah, I mean, I guess it's just sort of thinking whether they go with how you're saying, or they go the centralized route instead. I mean, it really, I think NBA Top Shot will be a great model. Like, will be kind of the model for a lot of retail investors. Not retail investors, sorry, big consumer products. So yeah, but thank you.
Look, I mean, where there's people are in a rush to just take money at the moment, and you know what? Like, I'm not like dogmatic about this. Like, each to their own. I think, but long term, a lot of these fundamentals will begin to be understood, and then increasingly, like the franchise who owns that IP will understand, like, if they want that asset to have a greater premium, then they need to make sure they're working to new standards around royalties and stuff. I think it's not a topic that's talked about enough, but it will do, as you say, precisely because some of these things are going for ridiculous amounts of money.
Yeah, precisely. Thank you. Thank you very much.
Send me the link. I'd like to see what you're working on.
Yeah, I can. I'm with LBL, so I can just speak to Hugo and get that. So yeah, thanks.
Cool.
Yeah, great question, Gibran. Simon, I think you're next. You may be muted. Yeah, there we go. Simon? Okay, well, we'll go on to the next one, hopefully. Simon can ask his question a bit later. I suppose, sorry, there we go. Rafe, Simon, you're there. Okay, Dagan, do you want to ask yours in the meantime?
Sure. I'm very fascinated by NFTs, and I've been looking into the space for quite a while now. You talked a lot today about NFTs in the collectibles and gaming and artwork space. Are you also looking at NFTs and like for the more boring things like mortgage contracts that are like directly tied to your house, or NFTs for health records, or other things, that all the other non-fungible data that's in the world right now?
Yes. Yeah, absolutely. And, you know, I didn't mention it because, as you say, it's slightly unsexy, but one of the interesting, and there's some regulatory considerations, but one of the interesting things about NFTs is that they can allow for income-bearing instrument, right? So if you look at the problem with most DeFi at the moment, it's like yield not really based on any real world income. It's just kind of manufactured yield, and or kind of, you know, arbitrage. Now, the great thing with NFTs are, as you say, they could be an insurance policy. They could be, you know, associated to any alternative asset. So this is definitely going to happen, I think, and it'll happen most quickly in DeFi. The challenge with that is, as I said, the regulatory one, because if you have a digital asset that has one of two things, and preferably not both, and by the way, this sounds a lot like a governance token, and everyone working on governance tokens should consider this. If you have governance rights and you have a right to income, that sounds a lot like equity, and regulators at some point will be looking at that quite seriously. So, you know, effectively that would then make an NFT a security token. And so the question then is, in what environments can you have security tokens? Because the problem with security tokens are that they contaminate a decentralized system. So, for example, that's why most exchanges do loads of delistings at the moment, because if anything they think could be remotely regarded as a security by, especially in the US, they just delist it immediately because they don't want to contaminate what that's been traded with, the trading pairs and all kinds of stuff. So the question is, you know, do you then have specific environments where an NFT can represent a security? To what extent can those asset pools be mixed? So, you know, could I swap a non-security for a security or vice versa, without contaminating the other? I think the answer is probably yes, but I don't know exactly how yet. But I think that there's just so much money that there's a real economic incentive for the market to figure it out. And usually where there's that incentive, it happens. But yeah, it's not something that we're directly looking at the moment for those reasons. Because again, the minute that you've got to get $3 million to get a license to experiment with a concept, it becomes prohibitively high. So it might be that you see institutions do that before a startup. But, you know, let's see. I know Bermuda, for example, Bermuda is actually the global center for the reinsurance industry, for example. So I think it's like trillions of dollars of reinsurance are done out of this tiny island of 15,000 people, or maybe even less. And I know that they are looking at their regulator creating a sandbox through which you could have experiments in things like NFTs for insurance instruments, related instruments that will be traded initially within a controlled group of approved parties, but then could effectively be done in a more DeFi way. So it is happening, but it requires to be blunt, the UK should be all over this. We've been lobbying Treasury and the FCA for years. The FCA get it. Treasury, for some reason, have just been a pain in the ass. Although I did see a recommendation released last week by somebody on how the UK could be a global hub for crypto, but they've got to move fast. So fingers crossed. Exactly, the Khalifa report.
Thanks, Jamie.
Yeah, thank you. That is really interesting. We'll just we'll just prioritize those who haven't asked yet. So someone's got that Gem PCE. That's what your name reads out as. If you'd like to ask a question. If that's not going to work, we'll go on to.
No, they've just unmuted. I think they're trying. Or not, forgive me.
Rafe, you have another question in the chat. So does there need to be a better alternative to OpenSea for standardizing pricing of NFTs if they are to be used as collateral in DeFi?
Yeah, and there already are emerging things. I think OpenSea play a vital role at the moment. But for example, nonfungible.com are working on allowing for better fundamental analysis of pricing NFTs. And that is going to be increasingly important as you're going to have more bots. Like it or not, there are going to be more bots looking for arbitrage opportunities. And equally, there are things like niftyfi.com, which are doing borrowing and lending for NFTs. And currently, the only ways you can establish, because of most NFTs have thin liquidity, so it's very difficult to establish a pricing floor, which is why people like collectibles and generative art, because you have a ready-made, rather than a market of one or two with thin liquidity, low liquidity, you have an instant market of 100 or 1,000, so you have greater trading activity to price. But can you hear me okay? Cool, sorry, my ear thing went a bit funny. So for example, niftyfi, the guys there, Stephen, they reckon that currently the only way to actually price an NFT other than trying to sell it is through getting a loan out against it. That'll establish a true floor. So actually getting a lot of borrowing and lending, and some people are borrowing with the aim of the other person defaulting, so they could try to get a better price on, say, CryptoPunk. So I think you're going to find different ways of pricing these instruments, from DeFi and borrowing and lending and using them as collateral. You're going to end up with more fundamental analysis to feed into trading algorithms, things like nonfungible.com. You're going to end up with fractionalization or sharding of individual NFTs, like we're seeing with Beeples and I forget what it's called, B6 or B3 or whatever it was, where they've sharded a Beeple that they bought for a couple of million. So all of these B20, there you go. All of these things are ways in which you can price a fairly illiquid asset, or at least establish some kind of pricing floor.
Brilliant. So I'm aware of the time, Jamie. You've been incredibly generous with your time. So if you have to go, that's absolutely fine. I'm pretty sure I speak on behalf of everyone here, and now I've learned so much. Really, really interesting. All different sectors that are proving really relevant. And this is to everyone. If you haven't read the paper, I really recommend it. It breaks a lot of things down in different sectors. Otherwise, follow Outlier on LinkedIn or Twitter. They're always tweeting a lot. Come and join our Discord. I'll just share it now. We have lots of different channels open, which are, linked to trading, or there's a DeFi one. There's now an NFT one. All sorts of things. Our future events will be advertised through there. But yeah, thank you so much for coming, guys, and thanks again to Jamie. I've really, really enjoyed that.
Yeah, thanks everybody. Great questions. And make sure you follow Outlier on Twitter. It's OVO-IOHQ. If you've got an early stage startup working in the space, apply to our accelerator, outlierventures.io/basecamp. Subscribe to our YouTube channel, youtube.com/outlierventures. We're doing lots of interviews. We've got the Founders of Web3 podcast on iTunes. As I said earlier, very keen to engage with a community like this, both for Outlier, but also for our portfolio. As I said, we'll have just under 100 startups in our portfolio by the end of the year. Technical talent is very scarce, both in terms of computer science and coding, but then also kind of economic design, incentive design, game theoretics, stuff like that. So make sure you reach out, connect. We'd love to keep in touch with you all.
Okay, brilliant. Well, yeah, thank you very much again, and cheers, guys, for coming.
Thanks, guys. Bye.
Thank you, everyone.
And apologies to those whose questions didn't get answered, but hopefully the other ones made up for it.